Focus. Ideate. Innovate. Enable.
Hello and welcome to another episode of NSE FinWiz, powered by CNBC TV 18 Season 3. Today we are at the Pune campus of a Nasdaq-listed IT company, Syntel. Syntel is a leading global provider of integrated information technology and knowledge process outsourcing solutions spanning the entire life cycle of business and information systems and processes.
All of us work really hard for earning a living, and personal finance is a very key aspect of how you can plan your life. Obviously, all of us start out with the basics in mind, building a career, getting into the workforce, but very quickly our aspirations and our life goals take over.
NSE FinWiz visited Syntel in Pune with the country's finest experts to advise and educate the young employees on investments and financial planning. We are now joined by two very special experts. We have Kalpesh Ashar, who's a certified financial planner, and he's with Full Circle Financial Planners and Advisors. Welcome to the show, Kalpesh. And we have Hemant Rustagi, who's the CEO of Wise Invest Advisors. Welcome to the show, Hemant. And our core topic for today is equities. So, Hemant, let's get started off with you. Now, equities, everybody says equities, we should put money in because you get big amount of money in that. But there is this greed versus fear term that sometimes people use also. What is that? Can you simplify that for us?
So I think, Sumit, that happens in every walk of life. I mean, whatever we do, at times we get greedy, at times we get fearful. I think if you talk about investing in equity, I think that's something that happens all the time. So when do we get greedy? Whenever the markets are doing very well, there is everyone talking about making a lot of money in equities. Your friends are making money, your relatives are making money, your neighbors are making money. That's where we all get greedy, thinking, if there is a money to be made in the equity market, why not I invest money in equities without understanding what are the attendant risks? We get fearful. When do we get fearful? When the markets are down. We hear stories of somebody has lost so much money, somebody else has lost so much money. Then we think equity is not the right investment option at all. So we become fearful. In reality, when other people are getting greedy, that's the time we need to be a little fearful. Because it's quite possible the market may have reached the peak. So if you invest without a clear time horizon in your mind, possibility is that if the market tanks after 6 months, you may be seeing losses. Similarly, you need to become greedy when others are fearful, because that's a time when the markets are down, and that's a time where the market presents a number of opportunities for you to make money. But unfortunately, what we do is completely opposite of that.
So, Kalpesh, adding on to what Hemant is saying, this is what happens that, the markets will obviously be up, they'll be down, because markets have cycles. They keep going up and down. But what is your advice when people come to you? How do you explain this fact to them that the markets, yes, are volatile, but that's the nature of them, and that's what we have to accept and keep into account when we invest in the stock markets and the equities?
Okay, if we say that per se that equity is one asset class which is going to deliver the best returns over a longer period of time, and it is the sure shot way of creating wealth, then this beast called equity has to be tackled.
Okay.
And when we say that, how do we tackle it? So, like you rightly said, that equity markets move in cycles. And there are various reasons why they move in cycles, because of the economic conditions, the monetary conditions, so on and so forth. There are many reasons for that. Now, when an individual wishes to invest in equity, and using the phrase greed versus fear, taking on that, what we need to do first when a person starts his footsteps into equity is controlling his greed and overcoming his fear. Once these two things psychologically he is attuned to, and he has a sure shot set of goals, which are surely long term. Because to ride out the volatility, say for a 5, 10, 15 year cycle, you need time on your side. And if you can sync that with your long term goals, equity, as past record has shown, and as what we are all believing in, surely the India story and the way things are panning out, equity is the way that people can create wealth. But as I said, you need to control your greed, not look at your neighbor or what your other cousins are doing, and look at your goals for the long term and stay invested with some good choices which you've made.
So the first question is from Kalpesh Ashar, and he says, as a conservative investor, which is better to invest in, equity, debt or gold? What would you say?
Okay, now the parameters are completely different. So when you say that if you are a conservative investor, surely equity goes out of the bucket. So the choice comes between debt and gold. Now, when we say that a debt component is something of a fixed income security, it is a financial asset, whereas gold is what we know of gold, that is a commodity. Now, over the years, we have been brought up, we've been told, especially we Indians love gold. And that takes, no common sense to tell that nobody would tell in India, at least, that don't invest in gold. But we personally, in the field of financial planning, and over a period of time now, even the government is pushing it a lot, that we need to get out of this myth. And I would surely call it a myth that gold would outperform the returns over a period of time. At best, it could beat your inflation, which is hovering around 7 to 8%. So if you're ready with that type of a return and you want to stack up gold, then it's fine. And even that now is turning a new page because of the gold monetization scheme. The government wants your gold coming out of the closet, making it more financial and, putting that money to use. Coming to fixed income securities, we have two choices. So either if you really, really don't want to take any type of a call, as we all do, put your money in a bank FD. A bank FD would give you a conservative 8 to 9%, which is taxable. Again, 7% if you're looking at inflation. Post-tax, it will not beat your inflation also. But that will at least let you sleep well at night. Now with probably, I would say just a 2% higher risk than a bank FD, we have the brilliant option of investing in debt mutual funds. So in debt mutual funds, we have a horizon of 3 years and above where long-term capital gain seeps in. And with that 20% long-term capital gain with indexation, surely you will beat a bank FD. But there is a very slight element of risk because of the various interest rate fluctuations and so on and so forth. So being a conservative investor, that is the answer which I could give to you.
You're watching NSE FinWiz powered by CNBC TV 18 Season 3. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE FinWiz powered by CNBC TV 18 Season 3. Hemant, okay, so now we've been talking about equities, which is great. But what about the layman investor? If they say that, great, okay, I'm convinced, I want to put my money in the stock markets, I want to buy shares, but I don't have the time and I don't have the knowledge to go check all, the balance sheets, the EPS, the PE of every company that I invest in. What's the easier way out for that?
Sumit, there are two important things there. I think anyone who wants to invest in equity, I think first thing is very important to understand. Okay, taking a cue for what we discussed earlier. Because when you're investing for the first time in equity, it's very important for you to understand what equities are all about.
Yeah.
As I mentioned earlier, you have two options, two financial asset classes you're looking at, debt and equity. The basic difference is when you invest in debt, whether it is PPF or even putting money in the bank, you're actually lending your money. When you're lending money, you're only going to get interest. And to make sure that your money is safe, what do? You go to a bank because you feel your money is safe. You put your money in PPF because you feel your money is safe. You don't necessarily go into debentures and non-convertible debentures because you're not very sure about ratings. So that's one aspect. When you look at equity, okay, equity means you own a part of the company. Even if you have 100 shares in a company, you become a part owner, which means all the risk that are associated with the business, as an owner of the business, come to you in that portion. So clearly, first thing when you look at equity, you need to understand that you are going to be owning a business. And when you own a business, there are going to be ups and downs. There are going to be cycles. There are going to be domestic factors, international factors that are going to impact your investment. But you cannot grow businesses overnight. You need to stay invested in equities to actually get the real potential of that asset class. So I think anyone who looks at equity should begin with that.
How you are following value investing and what is interesting value and how you are finding in a stock?
Okay, now there are two ways to look at this. If you look at it from individual investor's perspective, you will have to do a lot of research. And if you look at it from a mutual fund perspective, leave the job to an efficient fund manager. Because fund managers adopt, two types of investing, value investing and growth investing. Now, answering your question, what is value investing? They would always look at companies basically which have a hidden value in them, but due to certain reasons, the efficiency or the share price or the performance is not come out at that point of time. So probably those beaten down companies which have a reputation, or there is a better value to be unearthed over a period of time, is all about value investment. And finding those companies at a point of time is actually an art. And that is why we keep on advocating the point that fund managers always propagate value investment stocks. So because of value investment stocks, if not today, the value would come out. And for that you need to remain invested. So it's like, finding that there is a gem, but you need to cover some dust off. So the concept of value investing probably stems from that.
We usually see that there is a lot of tax saving funds, and if my 80C is covered, I don't want to go into a tax saving fund. Shall I still stick with a tax saving, which is like a good performing fund? So
Okay.
how shall we decide that?
When you say tax saver funds, they are obviously under section 80C, as you rightly mentioned. And the name is actually in the mutual fund thing is ELSS. Those are equity linked savings schemes. Now once the word equity is associated with it, and as we've been just trying to explain, that when you say equity, it's for a long term. Now the way the ELSS funds are structured, they come in with a 3-year lock-in period. They start off as close-ended funds. And once your initial, your investment which is there, whether you do it initially or keep on investing it, completes 3 years, automatically it turns into an open-ended fund. So the parameter of an equity fund still remains. Only thing, that tax benefit which you had invested in the financial year, you benefit from that. Again, you have to invest in the next year for the next financial year to get that benefit if you want to. But because the word equity is there, it doesn't mean that 3 years, once the period is over, that's the end of the world. In fact, after 3 years is when the real story would start. So many funds, if like as the market performance is, would perform in 3 years, would not perform in 3 years. But if you have again set your asset allocation right and got your call right, dividing between equity, debt, or complete equity, complete debt, whatever is your call, and you've invested for 3 years, you should remain invested in it for a longer duration of time. Because then it works exactly like an open-ended fund. And you're free to remove your money after that.
On that note, it's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE Fin Wiz, powered by CNBC TV 18 Season 3.
Investor has bought a share with a face value of like let's say rupees 10, and he has bought at the market rate of let's say 20 or 30. But in the market crash or whatever happened, the share price has come below the face value of rupees 10, let's say the 1 rupees or 50 paise. So is there any option the investor is left with, so he can choose some options so that he can get his money back on the face value, something like that? Because ultimately it's below the face value of a share right now.
There are a number of shares where people invest without understanding what the company does, or there is a fancy for buying stock which have a lower price, thinking that there is a value. They confuse value with a lower price. Okay, not necessarily that a share which is you're buying for 20 rupees or 25 rupees has a lot of valuation in that. So if it goes below the face value, that's the risk that you need to take. In fact, it is quite possible at times that you may not even find buyer at that price. So, you may be stuck with that. That's why we always recommend that if you do not have the wherewithal to select the stock yourself, take the mutual fund route. Because what it does for you is, you get a diversified portfolio, you have liquidity, you will not face this problem because the mutual fund manager will ensure that he does not invest in these kind of companies, or even if the stock is falling, coming down, maybe he'll exit at the right time. And the third important thing is the open-ended fund provides liquidity at any point of time. So you don't have to worry about it, whether I'll get the money or not. So I think that's a risk that you need to understand when you're investing in equity, that whatever the price comes to, you have to bear with it. There is no way you can demand that, okay, I should get my face value back.
Is it advisable to go for a ULIP plan with an insurance part in it, or just go for a separate term insurance?
Okay, I'll start off with just a simple sentence, which probably would summarize everything. It is that insurance is for protection and investment is for growth. Now let's start with a product which is a ULIP. And if you were to bifurcate the words, it is unit linked insurance plan. Okay, and the word unit in that signifies the investment part. Now the unit are also common with the mutual fund units. So even when you invest in a mutual fund, you are buying units and they are invested in capital markets. So obviously in a ULIP also, it's a combination of both. We very strongly advocate that insurance and investments should never be mixed. Because if you see the cost factor and the transparency both, the transparency in a ULIP, although the regulatory authorities have now made it a point after a lot of realization and a lot of noise being made about it, that there should be more transparency in how a ULIP is structured. Whereas the cost in a ULIP also, the premium which you pay, is much higher than a term plan. And the amount which is the insurance element which is covering you for the risk is very less. So you are neither in this territory of protecting yourself adequately, nor completely putting both your legs into the investment boat and riding it. So it's more of a very ambiguous type of a thing. Again, there are thoughts that a ULIP over a period of time, because it is linked to capital markets, would do the job for you. But my strong stand is, if it's for the long time, why can't we put in a more clearer and a more simpler product like a mutual fund?
All right, that's all the time that we have here. Thank you so much, Kalpesh. Thank you so much, Hemant. And thank you so much for having us here.
As a culture, Indians save. It's a part of the Eastern cultures. However, I think, the session today gave us a lot of insights into, the long-term, what our short-term and long-term financial goals should be and what are the appropriate instruments for us, keeping in mind those goals.
This was a really good show. It gave a lot of visibility with regards to the financial investment plans, various financial investment plans. It was an opportunity for all of us, actually a very good opportunity for all of us to interact with the experts, seek necessary guidance with regards to right investments.
Well, that's all on this episode of NSE FinWiz, powered by CNBC TV 18 Season 3. But we'll be back next week with another set of young employees at another company. Until then, here's a chance for you to win a cool goodie bag by answering this viewer question.
An illiquid market is also called a thin market and is characterized by A. The lack of buyers and sellers. B. The lack of alternative investment avenues. C. The lack of stocks traded. Send in your answers at fwq@network18online.com.
We'll see you next week with another set of young employees at another company. Until then, from the entire team, many thanks for watching.
Focus. Ideate. Innovate. Enable.